Welcome back, team. We will now talk about lending tiers and funding solutions. In this session, you'll gain a clear understanding of how lenders categorize businesses into risk tiers A, B, and C, and how that classification impacts funding approvals and loan terms. You'll learn how these risk tiers affect our core funding products, including merchant cash advance, term loans, lines of credit, and reverse consolidation. More importantly, you'll see how to match each merchant's profile to the right funding solution while setting realistic expectations from the start. This training will also introduce you to new details about C-paper funding, including short-term deals ranging from 20 to 80 days, stacked positions, borderline C-plus situations, and when reverse consolidation may be the best option. By the end of this training, you'll have a holistic understanding of A, B, and C-paper clients, which funding products fit them best, and how to present those solutions effectively to close more deals. Let's get started. Lenders categorize businesses into A, B, or C tiers based on key financial and risk factors. These tiers help determine approval chances, loan terms, and the best funding options for each merchant. A merchant's credit score is one of the biggest factors, along with their number of negative days or non-sufficient funds. Time in business also plays a role. Established businesses tend to qualify for better terms than newer ones. Lenders also evaluate daily balances, since businesses with higher, more stable balances are seen as lower risk. Another key factor is the number of existing positions a merchant has. A business with 1 or 2 positions is in a much better position for funding than one carrying 4 or 5 advances. Lastly, lenders consider industry risk. Preferred industries typically get better offers, while higher-risk industries may face stricter approval conditions. As an account executive, your job is to quickly assess these factors and match the merchant with the right funding solution. Keep in mind that tiers are not always black and white. Some merchants fall between B and C tiers if their financials are borderline. Understanding the full picture helps you position the best funding options and set the right expectations from the start. Lenders offer a range of funding products to match different risk tiers, helping businesses get the capital they need while balancing risk. Let's go over the main options and which types of merchants they best suit. Merchant cash advance is one of the most flexible options, with daily or weekly repayment schedules. It works across A, B, and C risk tiers, as long as the merchant has strong enough revenue to support the payments. Term loans provide fixed repayments over 3 to 24 months, though prime A paper clients may qualify for even longer terms. These loans are typically best for A and B paper clients, though borderline C paper merchants might qualify for a very short term if their other financial metrics are strong. Lines of credit function as a revolving credit line, where the merchant only pays interest on what they draw. These are usually reserved for A paper or strong B paper clients, particularly those with stable daily balances and solid credit. Internally, commissions on lines of credit are lower, so we generally only push them when they're truly the best fit for the merchant. Reverse consolidation helps B and C paper merchants who are carrying multiple stacked positions by restructuring their payments into a single lower outflow. However, we never use the term reverse consolidation with merchants. Instead, position it as a program that can help reduce your weekly payments by 30 to 50%. Short-term bridge funding is designed for merchants who need fast capital for immediate needs. These are 3 to 6 months deals, commonly used by B and C paper clients who need quick access to funds. Some A paper clients may also take advantage of bridge funding if they're waiting on a larger deal, such as an SBA loan, but need cash now. Understanding these products allows you to match merchants with the right funding option based on their risk tier, helping you set proper expectations and close more deals effectively. A paper clients represent the lowest risk category for lenders, meaning they qualify for the best loan terms, higher funding amounts, and faster approvals. These merchants typically have a credit score of 650 or higher, with top-tier clients often scoring above 700. They have very few, if any, negative days, usually no more than 3 in the last 30 to 90 days, and they maintain strong daily balances. Their existing debt is minimal. They may have 1 or even 0 active positions, which makes them even more attractive to lenders. Time in business is another key factor. A-paper merchants have typically been operating for at least 2 years, with stable, predictable revenue. They are also usually in preferred or at least moderate risk industries, meaning they don't fall into high-risk verticals that lenders tend to avoid. Because of these strong financial indicators, A-paper clients qualify for the best approval terms. 12 to 24-month repayment periods are common, and if all factors are strong, some lenders may even extend beyond that. These merchants also receive lower factor rates or interest rates and higher funding amounts since they pose less risk. The underwriting process is faster and requires fewer documents, making approvals quicker and smoother. Here's an important tip. If a merchant has a credit score of more than 650, but everything else is immaculate, no negative days, strong daily balances, 2 or more years in business, and only 1 existing position, they can still land a 12-month deal, and in some cases, even push up to 18 or 24 months, depending on the lender's guidelines. These are your best clients to work with because they qualify for longer terms, better rates, and higher approvals, allowing you to close deals efficiently and maximize funding opportunities. B-paper clients fall into the moderate risk category, meaning they still qualify for funding but with stricter terms compared to A-paper clients. These merchants usually have credit scores ranging from 550 to 699. Not bad, but not strong enough for prime funding terms. They may have some negative days or non-sufficient funds, typically between 2 and 9 in the last 3 months, but their cash flow is still manageable. When it comes to existing debt, B-paper clients typically have 1 to 4 positions, but they aren't severely over-leveraged. They may also be newer businesses, sometimes with just 1 year in operation, or they might fall into an industry that is borderline high risk. Their daily balances fluctuate, but not so much that it raises major red flags for lenders. Because of these factors, funding terms are more restrictive than A-paper approvals. Interest rates and factor rates will be higher, and term lengths usually range from 6 to 12 months. However, if their daily balances are steady and their negative days are minimal, some lenders may extend the term to 8 to 12 months. The underwriting process for B-paper clients is often more detailed, meaning underwriters may request additional bank statements or clarifications before making an approval decision. Here's an important tip. B-paper clients can work their way up to A-paper terms by reducing negative days, paying down stacked positions, and building a strong repayment history on a short-term deal. They can gradually improve their standing and qualify for better funding options in the future. B-paper merchants are still fundable, but they need realistic expectations about terms, costs, and underwriting requirements. Setting the right expectations from the start ensures a smoother funding process and a better experience for both you and the merchant. C-paper clients fall into the highest risk category, which means funding is much harder to secure. These merchants typically have multiple financial red flags, such as frequent negative days, low credit scores, multiple stacked positions, or very little time in business. A typical C-paper merchant might have a credit score between 500 and 600, sometimes even lower than 550. They're often carrying 3 to 5 existing positions, meaning they're already heavily leveraged with multiple advances. On top of that, they tend to have frequent negative days, sometimes 10 to 14 in just 3 months, which signals cash flow instability. Some may have been in business for only 6 months or have very low daily balances, making them even riskier to fund. Even if they operate in a preferred industry, their financial situation pushes them into the C tier. An extreme C-paper merchant might check almost every risk box. Imagine a business with 14 negative days, 3 open positions, a 500 credit score, and only 6 months in business. In this situation, their only funding option might be a very short-term merchant cash advance, something as brief as 20 to 30 days. This means 1 month of repayment, an extremely high cost, and a difficult structure, but for some merchants, it's the only way to secure quick capital. Then there's what we call a C-plus merchant, someone who is slightly stronger than a typical C-paper profile, but still carries too much risk. This merchant might have a credit score between 550 and 650, or even borderline 650, but with 4 or 5 existing positions. They've been in business for 3 or more years and have fewer negative days, maybe 3 to 6 in the last 90 days, but because of how many positions they already have, they still fall into the C tier. Merchants like this might qualify for a 40 to 80 days merchant cash advance or a reverse consolidation to help restructure their payments. When it comes to solutions, options are extremely limited, but there are still ways to get them funded. A very short-term merchant cash advance, ranging from 20 to 80 days, is usually their best bet, though the cost will be high. Reverse consolidation is another possible solution, especially for those with multiple stacked positions, as it helps reduce daily and weekly payment burdens. But remember, we never call it reverse consolidation when speaking with merchants. Instead, position it as a program that helps lower weekly payments. Here's an important tip. If a merchant already has 4 or 5 positions, that's a clear sign they're C-paper. Even if their credit score isn't terrible, taking on another advance puts them in a 5th or 6th position, which means extremely short terms and high costs. The best approach for these clients isn't just adding another loan, but rather helping them manage their existing obligations more effectively. If they're open to it, reverse consolidation may be their best option to regain control of their cash flow. The key with C-paper merchants is to set realistic expectations. They may not love the terms they qualify for, but if they successfully pay off a short-term deal, they can work their way up to better funding options over time. The lending tier a merchant falls into directly impacts their approval rate, funding amount, and the terms they qualify for. Lenders group merchants into A, B, or C-paper categories, and each tier comes with different expectations. A-paper clients have the highest approval rates, qualify for larger funding amounts, and receive the best terms, typically 12 to 24 months or even longer, with the lowest cost of capital. These are the most attractive clients for lenders because they pose the least risk. B-paper clients have a moderate approval rate, meaning they still qualify for funding, but their loan amounts may be more limited. They typically receive 6 to 12 months terms with mid-tier pricing, slightly higher than what A-paper clients get. These deals are still fundable and reasonable, just with a more cautious approach from lenders. C-paper clients, being the highest risk, have the lowest approval rates and often qualify for minimal funding amounts. If they're approved, their terms are much shorter, typically 20 to 80 days or, in some cases, 3 to 6 months, but always at a high cost. Because of their financial challenges, many C-paper clients may need reverse consolidation to help manage their heavy stacking of multiple positions. Why does this matter? A-paper clients have the most flexibility, qualifying for longer terms, larger funding amounts, and the lowest rates. B-paper clients land somewhere in the middle, with 6 to 12 months terms and slightly higher costs. C-paper clients, however, face short deals, high factor rates, and may need a restructuring strategy like reverse consolidation to stay afloat. Understanding these tiers allows you to set clear expectations with merchants from the start. The more you align them with realistic funding options, the smoother the process will be, and the more successful your deals will become. One of the most important parts of funding is setting the right expectations from the start. That means asking the right questions to determine which lending tier the merchant falls into, and then communicating realistic funding options based on their financial profile. Start by assessing the merchant's credit score. Are they in the 500 to 600 range, somewhere between 600 and 699, or do they have a strong 650-plus score? Next, look at existing positions. Do they have just 1 or 2, or are they stacked with 4 or 5 open advances? Negative days also play a huge role. If they have 3 or fewer in the last 90 days, that's manageable, but if they have 10 or more, that's a major red flag. Time in business is another key factor. A merchant with only 6 months in business will have fewer options compared to someone with 2 or more years of experience. Finally, look at their daily balances. Are they stable and consistent, or do they frequently hover near zero? Once you've identified their tier, it's time to communicate funding expectations clearly. For an A-paper merchant, you can confidently tell them,
You may qualify for a 12 to 24 months term at very favorable rates.
these merchants are in the best position to secure long-term funding with competitive pricing. For a B-paper client, you need to manage expectations by saying,
We can likely fund for 6 to 12 months. The rate will depend on factors like negative days and credit score, but you're in a solid range.
this prepares them for moderate pricing and term lengths without overpromising. For C-paper merchants, you have to be direct about their limitations. Let them know,
Because of multiple positions or heavy negative days, the term is going to be short, maybe 20, 40, or 80 days.
if they're struggling with stacked positions and cash flow, guide the conversation toward reverse consolidation without calling it that. Instead, suggest,
We can discuss a program that helps reduce your weekly payments if that's a better fit.
by setting clear and realistic expectations up front, you avoid surprises, build trust with the merchant, and position them for the best funding option available based on their situation. We've covered how lending tiers impact approval rates, funding terms, and which products best fit each type of merchant. Now let's summarize the key takeaways and what to do next. A-paper merchants have minimal negative days and positions, strong credit at 650 or higher, and stable daily balances. These merchants are in the best position to secure 12 to 24 months deals with the most favorable terms. B-paper merchants have some negative days, credit scores between 550 and 699, and usually 1 to 4 existing positions. Their funding options typically land in the 6 to 12 months range, with moderate pricing based on their risk level. C-paper merchants are the most challenging to fund. They may have up to 5 or more existing positions, frequent negative days, or credit scores near 500. Their options are very short-term merchant cash advance, typically between 20 and 80 days, or possibly a 3 to 6 months bridge loan, though at a higher cost. If they are heavily stacked, they may need to consider a restructuring solution to manage their weekly payments. Each tier guides which product is feasible. A-paper clients might qualify for a term loan or line of credit, while B-paper clients may need a standard merchant cash advance or a short-term loan. C-paper merchants are usually limited to small merchant cash advance or a specialized consolidation approach to help manage existing debt. Moving forward, use these guidelines when pre-qualifying merchants and quoting terms. If you see a merchant stacked with 5 positions or showing 14 negative days, be prepared for a very short-term, high-risk C-paper deal. And one final note, never use the term reverse consolidation when speaking with a merchant. Instead, position it as a solution that helps reduce their weekly payments and improve cash flow. By applying these insights, you'll be able to assess merchants more efficiently, set clear expectations, and structure deals that fit their actual financial profile, leading to better approvals and smoother closings.